Surely you don't want to pay more stamp duty than you actually have to. Then you're going to want to get your hands on a stamp duty valuation. Hey everyone, Andy from Duo Tax here. Paying stamp duty is an unavoidable part of buying an investment property. Now, I often get asked if you need to get a stamp duty valuation done whenever you buy a property, but you won't always need one. There are only a few circumstances where it's completely necessary. So it's worth knowing when you might need to have a property valuer produce a valuation report. After all, who wants to pay a cent more to stamp duty if you don't have to? So I thought I'll introduce you stamp duty valuation to clarify any confusion about what they are and how they work. But before getting started, I want to be clear that this video is for informational purposes. In no way should you interpret this as tax advice. We always recommend working with a qualified accountant or tax agent to give you the best advice for your situation. Stamp duty is one of the biggest expenses you pay when acquire a property, but so many investors are hit with a nasty surprise when they realize how much stamp duty they have to pay. So let me first explain what stamp duty is and when you will need to pay it. Stamp duty is a form of tax levied by the government to transfer the property from the seller to the buyer. The amount you have to pay is dependent on a few factors. Number one, the state or the territory you reside in. Number two, the property's purchase price. Number three, whether you're a first-time home buyer or not. And number four, whether your property is your primary place of residence or an investment. To find out more about stamp duty fees, I've left a link in the description box below. The articles cover each state and territories and whether it's a tax-deductible expense. As I mentioned earlier, stamp duty valuation aren't compulsory in every circumstances where stamp duty is payable. Usually, the State Revenue Office will accept an assessment of the stamp duty payable based on the selling price that appears in the contract of sale. But if the sale of the property is negotiated between parties who are related, the Office of State Revenue will need to ensure that the amount of stamp duty being paid is following the property's fair market value. It's worth noting that there doesn't need to be an exchange of money between the parties for stamp duty to be payable. So based on that, you will usually need to get a stamp duty valuation in the following situations. Number one, when the property is being transferred between family relatives such as a grandparent and their grandchild. Number two, when the property is being transferred into a super fund. Number three, when the property is being transferred between trusts or other associated legal entities. In each of the circumstances mentioned above, stamp duty valuations need to be completed by a certified and experienced property valuer. So, what do we look for when we're putting the stamp duty report together? We'll consider factors such as the type of property, its size and build, where it's located, and what surrounding amenities like schools and shopping centers are nearby. We will also usually consider recent sales data of similar properties to gauge an indication of a similar market value. Once the property valuer has handed over your report, you will need to submit it to the State Revenue Office, and they will calculate how much stamp duty you need to pay. So we now know why stamp duty property valuations are crucial. It's because property valuers are legally liable for the valuation they provide. They are expected to apply due diligence in their valuation and provide information that's as accurate as possible. On the other hand, real estate agents don't have the same liability when conducting informal appraisals. So a real estate appraisal is great for when you need to estimate a selling price, but not for when you need to establish your stamp duty liability. Our team of property valuers here at Duo Tax have one mission only, and that's to save you money throughout your investing journey whenever you can. Remember, You're going to need a stamp duty valuation if a property is transferred between related parties or into a super or a trust. There you have it, guys. If you have any questions or just want to contact us to find out more about property valuations, make sure you drop a comment below. Otherwise, stay tuned for more property investing tips. I'm Andy Tran from Tax. See you next time.